Well, hello, everyone. I want to talk to you for a few minutes about what's called the road to financial independence. And it is, in fact, a road. The road has stop signs and traffic lights and detours and traffic jams and hesitations and all kind of things on the road. It's the same process on the road to retirement. And I want to just kind of go over that just for a few minutes now. Most folks don't plan to fail, they fail to plan. They don't think about credit cards and installment loans and life insurance and mutual funds and savings accounts and 401ks and bank accounts and mortgages and all the things that we have to make a living. Water bill, light bill, gas bill, cable TV, hairdresser, fingernail lady, barbershop, Kroger's and Winn-Dixie, Old Charlie's, Thank God It's Friday, Ruby Tuesdays, car insurance, life insurance, health insurance, home insurance, long-term care insurance, kids events, daycare, all these things that compete for our time. But we still have to have money to put back or make a way to have money to put back for a place called down the road. You know why? It's coming. And it's coming a whole lot quicker than we may anticipate. And so it's important then we plan for a place that we're going to be in for the rest of our lives. Now, there are three fundamental accounts: emergency fund, short-term account, and wealth building account. So what's the reason for an emergency fund? Just what it says, everyone, for emergencies. The heater goes out in the house at the dead of the winter. The air conditioning goes out in the height of the summer. The car transmission goes out, and it's the only transportation to work to take care of all the things of the home. That's an emergency. Short-term account, things that you're going to need for the next maybe 1 year, 2 year, 3 years. You want to set a goal to have at least 3 to 6 months of the money put back just in case the job lays us off. And we want to be able to live for at least 2 to 3 months, just normal. That wealth building account, this is retirement planning. This is getting to a time in life where we don't intend to go to work anymore, or at least want to have the option to transition and then do something else. So these three accounts are critical that we put these three things in place. Then we got to think about what type of investor we are right now in relation to what our goals and objectives are in the next 10 years, 15 years, 20 years, 30 years, 40 years. Am I conservative? Am I kind of in the middle of the road, moderate? Am I aggressive? Now, we got to make sure we don't have any real conflicts here, because if I say that I'm real conservative and I got 35 to 40 more years to work, well, that's going to cause some internal and economic conflicts. Because if you got 25 or 30 years or longer to work, it's important to think somewhat growth-oriented, somewhat aggressive. Why? Because over time, mutual funds have always done well over time. And you can weather the storm, and you can stand the volatility. Now, on the other hand, if you're already on up in age and you have a lot lesser time, well, you want to consider being a little bit more conservative, maybe a little bit moderate, because you're not trying to be real volatile. You can't stand all these big swings in the marketplace right now. So that's an important thing about that as well. Then there's something called the rule of 72. And what that rule says, if I divide my rate of return into the number 72, it's going to give us how many years it takes the money to double. You got a 3% here, a 6, and a 12. Now, I want you to look at this for a moment. At 3%, the rule says the money is going to double every 24 years. But at 6%, that money is going to double every 12 years. But at 12%, it's going to double every 6 years. So look at this scenario right here now, a little bit closer. By the time they get 24 years in at 3%, that 10,000 has grown to 20,000. At 6%, that 10,000 has grown to 40,000 in the same 24-year period of time. But at 12%, that same 10 has grown to $160,000 over that same period of time. In 48 years, the 10 has grown to 40,000 at 3%, 160,000 at 6%, but 2.5 million, to be exact, $2,560,000 at 12%. Now, I don't know what you believe. I mean, this is not, but people are really destroyed for the lack of knowledge. We got to agree on that. if we don't understand what we can do and how we can make our money work over time and get this information, it's going to not only affect us, it's going to affect the next generation, because the objective is to build what? Generational wealth. To leave some for the kids and the kids' kids is the objective. Now, it's important to also understand the investment phases. We got the accumulation phase, 18 to 55 years old. We're trying to make it grow. We're working hard. We're putting aside 1%, 2%, 3%, 4%, trying to make it grow. Then we get 55 to 65. This is preparing for retirement. This is the protection phase. This is the time you want to start thinking about, I believe, annuities. Some kind of protection of what you've grown over the years. The investments that have an insurance wrapper around it, to where it gives you an ability to get a certain amount of income from that annuity for the rest of your life that you can never outlive. And then you could name a beneficiary, to where if you don't take it all out, you can leave it to your primary beneficiary, and you can name a contingent. If something happened to you and the primary beneficiary, the number one person, at the same time, that's a big deal. You get all the way over to 65 plus, well, this is the time you want to start going to the mailbox, so to speak. Looking at your direct deposits to make sure that that investment firm, that annuity company, is putting those investments in your account like clockwork every month, coupled along with your Social Security. And if you have a pension, Social Security, maybe a Roth IRA, and an annuity, all these income streams, at retirement, you can retire. We all can retire with some degree of dignity. But it's going to take a plan right now, ladies and gentlemen. I want to encourage all of us, let's talk to our kids about this while they're still good and strong and young. Now, so what is a mutual fund? Look on the left side. You got a whole lot of individual investors like me and you putting in $50 a month, $100 a month, $500 a month for a long period of time till it gets up to where it's a large sum of money. We got folks that got 200,000, 3, 4, 500,000, a million, 1.5 million that they've saved over the years. Now they want to look at diversifying, I mentioned this a moment ago, and having some security, protection of that money. Well, in the beginning, they're trying to grow it. They got professional money managers. This is all they do, is invest their money for them over the long term. So how do they do it? Well, they put the money where we already spend the money. We've heard of consumers. We've heard of McDonald's and Duracell and all that you see here in Tide washing powder. We've heard of entertainment like the Walt Disney World and ABC Television. We've heard of pharmaceuticals like Pfizer and Lipitor. You've heard of telecommunications. What does Verizon say? Can you hear me now? We've heard of these type things. We've heard of technology like Microsoft computers and so on and so forth. So and all these things here. Why not invest money where we already spend money? This thing right here. Why not put money where we already invest money and make some return on where we're spending it? And what makes this world go around, this American economy? It is a big deal, ladies and gentlemen. And we got a chance to really get a better return on our money. Now, here's another thing. How can we make money in mutual funds? Well, 3 different ways. Dividends, capital gains, and capital appreciation. Well, now let's just kind of I don't have time to get into all the details of all of these. Well, let's think about capital appreciation. My wife and I bought this house back in not too long ago, and we paid a certain amount of money for this house. Well, a short time later, I don't know, 3 years later or so, it's worth about another $140,000 more than what we paid for it. It has appreciated. When we're buying mutual funds, we're buying shares of stock that go up in value, come down sometimes, but also go up in value. And over time, it is always, in a good mutual fund, appreciated in value. And one mutual fund, ladies and gentlemen, can have up to 150 stocks in that one fund. That is a big, big deal. So again, I want to encourage all of those that are watching this today, let's talk to our children. Out of high school, got a job. Out of high school, out of college, got a job. Out of high school, got a business, working for themselves, but the money's not working for them. So we got to talk to them about this, ladies and gentlemen. We got to talk to our kids about making the money work better for them. See, this is so very, very important. And another thing I want to talk to you about is what reasons should we invest in mutual funds? Well, number one, professional money management. Number two, diversification of assets. All your eggs are not in one basket. You have great growth potential. We talked about dividends and capital gains and asset appreciation. 3 ways to earn money. In a bank, you got one way, that's interest. And the return is so small. In banks, trying to think long term, it is, it's a shame what banks are paying now. And there are those that don't know any better, and they're going down, putting money in the banks for the long term, and it's just not going to get the job done. Affordability. We can put as little as $50 a month in mutual funds and have the same kind of management of those that's putting in $50,000 a month. And ladies and gentlemen, there are those that are putting in that kind of money every month. And also liquidity. Now, the objective is not to touch the mutual fund for the long term, particularly when you're talking about retirement planning, college planning. But if you have to, by law, they have to have the money in your hands within a certain period of days. So if you check your account, that account has, let's say, hypothetically, $30,000 in it. You need $20,000 out. You don't plan to touch it, but something happened, life happens, you need 20 grand. When you redeem that account, they got to have that money in your hand or in your bank account within a certain period of time by law. That's a big deal as well. Now, so another thing is not putting things off. Procrastination. I'm going to get around to it. 27-year-old kid here on the lower left-hand side. Putting aside $100 a month, you see it on the very top. They're going to put aside $100 a month until they're 6 to 7 years old. At 6 to 7 years old, at a reasonable rate of return, 9%, they got $471,000. If they wait to 28 years old, 1 year later, they got $430,000. That's going to cost them, you see it on the very top of that second bar, $41,000. They wait until they're 32 years old, they got $296,000, but it's going to cost them $175,000. If they wait until they're 42 years old versus starting at 27, saving $100 a month, $25 or less a week, they got $112,000. It's going to cost them, you see it, $358,000. Procrastination is the assassination of our determination. You've heard that. I'm going to get around to it. And ladies and gentlemen, let's encourage our children. Let's invest some money now. And then also, it's not too late either for us to do the same thing as well. How are we going to get it done? How are we going to get to that place? To get where you want to be, you need to know where you are now. And that's what it says on the screen. To get where you want to be, you need to know where you are now. The solution is a roadmap, a financial game plan, a financial needs analysis. Complementary, customized, and confidential. What does it do? It takes a snapshot of where that family is right now, a picture of where they are right now. And it looks at a few key things. Number one, it looks at protection management to make sure I have the adequate amount of life insurance on my life so as not to leave my family struggling and straining trying to get home. It looks at my insurance on my car, my limits of liability on my homes and cars and dwellings to make sure I have adequate coverage on my property. It also talks about in that foundation, do I have a will? Last will and testament. Do I have a living will? Do I have a durable financial power of attorney? Number two, it looks at debt management. The house note, the car note, the student loans, the credit cards, the payday loans, the balance, the payment, and the interest rates. It looks at number three, it looks at expense management, a budget. Expense management. What's going out for water bill, light bill, gas bill, cable TV, hairdresser, fingernail lady, Kroger's, the Winn-Dixie, Old Charlie's, thank God it's Friday. Car insurance, home insurance, life insurance, health insurance, long-term care insurance, renters insurance, boat insurance. What's going out in the budget? Number four is going to look at asset management. What am I saving every month to make sure that when I retire, I can retire with some degree of dignity? How much am I paying myself every month for down the road? Because, ladies and gentlemen, I want to tell you, you already know we all can agree that down the road is coming. We're not getting younger, but we are getting older. Asset management. Then the last one is, income management. That says, am I making enough money to make all the ends come together? And if I'm not making enough money to make all the ends come together, or even look at one another, it's all right to do something part-time to generate more income. We're talking about the road to financial independence. Ladies and gentlemen, y'all please take this to heart. Help me to spread this word. Please share this with one of your friends, your neighbors, your kid, your son or daughter, your neighbor, your in-law, your brother-in-law, sister-in-law, the pastor, the assistant, the deacon, the chairman of the board, the chairman of the trustees, everyone that you have to do. Let's talk about putting money back for down the road, because down the road is coming. Thank you.